In 2008, there were closings in real estate private equity funds to the tune of $142 billion. That was the peak year of fundraising in private equity real estate. The total in 2009, 10, and 11 together is $139 billion. So you've got the last 3 years that have equaled the fundraising of the peak year in 2007, and you can be sure that the GP, the general partner community, has not shrunk by 2/3. So there is a real scramble among the general partnership community to raise capital among a shrinking community of capital availability. That doesn't necessarily mean a shrinking pool of capital, but the limited partners and investors, sovereign wealth funds, pension funds, endowments have been able to and have been acting accordingly in a much more discerning manner. They're asking tougher questions, they're asking more questions, they're taking longer to make their decisions, and there's going to be a shakeout. There is a shakeout, and there's going to be fewer people in the market tomorrow than there have been over the last 10 years.
How does GIC currently view Europe as a place to invest? Are you interested in distressed property?
Sure. I think when I told my boss in Singapore that I'm coming here to speak on a panel about European distressed investing, his response is, "What distress?" And I guess if you look at the prime end of the market especially, the pricing that the prime assets are being sold at or transacted at, it's a question whether there's a distress in Europe or not. The few main conditions, I guess, for investment is one is that there must be confidence in the market, which I think there's a big lack of confidence in the European property market at the moment. Secondly is there must be growth. And I think in Europe that is also not really, you don't see a lot of growth. There's anemic growth for the next 2, 3, 4, 5 years. And the third element is financing. And I think that is also lacking in Europe at the moment as the banks are retreating back for various reasons that has been well articulated. So there really isn't a lot of things going for investing in Europe at the moment. But nonetheless, I think Europe is a significant part of our investment universe. It's here to stay. We don't believe that Europe is going to disappear by any means. So we still believe in the long-term prospect of Europe.
And so one of the interesting challenges for our real estate team is that they don't have the comfort blanket of knowing that we are trying to allocate a certain amount of capital to real estate. We have no innate geographical bias that is preferred. And so we approach life just slightly differently. And I'll agree with an awful lot of what Bernard said in terms of how he reads Europe and pricing for real estate. I would say much the same. We find pricing relatively expensive for real estate assets today in Europe, in the context of what else we can do with our money. And that is the essential challenge that we have. We will think about everything we do in a matrix form, which is boiled down simply into thinking about control, thinking about liquidity, thinking about return, and thinking about risk. And we try to meld those 4 things together to think about the attractions of doing anything and the form in which we do it, whether we do it directly or whether we do it indirectly.
I think if you take an honest look at how the GP-LP relationship has played out over the last few years in the context of the fund manager, with very few exceptions, it's been awful. There was too much leverage, there was too much velocity, the prices were too high, the thought and care given to the investments, particularly during the peak of the cycle, was inadequate. And there's a reason that there's been a retrenchment and a consolidation and a shakeout. And I think that one of the things that the investors around the world learned is that to the extent that we're large, like Welcome, like GIC, like some of the sovereign funds that everybody's been hearing about over the last few years, there is a better way. And that way may be to retain some discretion, to make larger allocations to investors on better terms with better governance and retaining better control. But there continues to be a number of smaller investors in the world that really do need the fund model, either because they can't get the diversification if they do a deal-by-deal strategy, and they just don't have sometimes the numbers to, if it's for example, if it's a $10 billion pension plan and they'd like to have 5% in real estate, there really aren't the GPs out there that are going to be able to work with them on a separate account basis. So it is definitely different courses for different horses, but I think that I've got all the respect in the world for the investors that have got the staff and the know-how and the capacity to work with general partners. And I think that the general partners that survive and flourish over the next 5 to 10 years are going to be people that get that and adapt to it, because there will be some people that don't, and I think what they're going to find is they're just not going to be able to attract capital in the ways that they used to.
We provide solutions. We are a solutions provider to the banks mainly, and if there is a distress in which we can capitalize, and we're fully aware of what Bernie is saying into how soft the economy in Europe is, we see it on a daily basis. We're a big bank, right? We have like 8 billion that we bought in the last 4 years. And we see it on a daily basis when you are renewing one lease, at what rents the level they come. So when you're doing in the Dutch market, you sign a lease for 5 years, and you have to give 3 years for free, plus maybe invest a year of rent in capex. Or when you have a property, maybe an industrial shed in UK, coming out of a dodgy portfolio, and the roof is falling down, and you have to invest the capex to replace it. So we see in the day-to-day all this distress that you're talking considerably, impossibility to get financing, but not maybe for us, because we get financing at the loan star level, but it's our buyers. We are in the business in which I personally, our GPs, make money when we distribute the money back to our investors.
Throw out a question to everybody here, and that is, there's a lot of talk about distress, and certainly from time to time distress opportunities do present themselves with banks, with property companies, with funds that may need liquidation. But there's one area that doesn't really quite fit for me, and that is to the extent that the European banks are trying to fill a capital hole.
Where is the distress? From the bank's perspective, if the value that they have on their books doesn't allow us for buyers to actually bid at a level in which we can make money, we don't even have a dialogue. If we cannot provide a solution to hit ourselves, our heads against the wall, we don't lose too much time. But the opportunity comes at one moment with a particular exposure that they want to get out, that they need to get out, that they don't have the ability to manage themselves. And that's when we come in.